Hello guys and welcome back. So today, this is kind of part 2 of a ongoing series, investing in Pokemon, where I kind of break down a lot of the different core aspects, and then in each video I'll go into each specific aspect about investing in Pokemon. So in this video I'm going to be focusing on two key concepts, the concepts of net versus gross yield and why that's so critical in analyzing cards, especially for graded cards and really high-end cards. So that's going to be the latter part of this video, and then the first part of this video is going to be talking about the opportunity cost. It's also kind of referred to as the cost of capital or the cost of money in finance. And so don't worry if you don't know what those terms mean. I'm going to start kind of, if you want to think of it as a pyramid, I'm going to start at the base, which is going to be explaining the terms, explaining how it applies to finance, then Pokemon, then at the very top, how you can act in an informed and cogent manner with this knowledge. It's just kind of helpful to be aware of these concepts when you are making purchases, either for your collection or for investing as a whole. And so let's just jump right into the concept of the opportunity cost, or the cost of capital. And so what this means, the opportunity cost is basically, so for example, I bought this card. We're going to say I bought this card graded for $100. What is the risk of this card, and what type of yield, what type of revenue could I have generated? Like, what's my ROI? How much money could I have generated with that same $100 if I invested in something else that wasn't this card with the same amount of risk? And with Pokemon cards and kind of these assets, it can be difficult because the opportunity cost can be quite high. And what I mean by this is the risk associated with purchasing, especially modern cards, is very high. And so, for example, with both of these two cards, PSA 10s, 2016, full art cards, promo, secret rare cards, because there's such a great risk, I need to be generating a higher return on investment, a higher ROI to compensate for that risk. Or else, well, as far as an investment goes, why would I buy those cards when I could just do something that either is lower risk for the same amount of return, or higher risk and higher return? And hopefully that makes sense. And then the real big issue with this, with the opportunity cost, is a lot of people see these big returns, right? They see returns of 20%, 25%, even 30% a year, right? You see these massive cards, Gold Star Rayquazas selling for $1,700 in PSA 9. I mean, just massive numbers, right? And they want to get that. But they have to understand the risk associated with that. This is kind of a risk and ROI type thing now. But it's still, with the opportunity cost, is with each bracket, right? The higher risk you go, the higher potential reward you go. So if you look at bonds, very low risk, very low return. If you look at equity, which are stocks, medium risk, medium return. And if you look at this, it's kind of at the very top of an investment pyramid as far as risk goes. Collectibles, kind of non-liquid assets like art. So they can have very high returns, but they're very difficult to liquidate, and they have a lot of risk, especially with these newer full art cards. And that's why typically, if someone has a lot of money that they want to invest in Pokemon, I'd typically say just buy some good old school cards. The artwork's fantastic, the kind of more hand-drawn style, and they are less risk. And typically with that less risk comes less return. So hopefully you guys are understanding the kind of ebb and flow, the kind of trade-off of that. And so now going into kind of shifting into the next subject of net versus gross yields, which is another kind of finance term. And that's, again, related to the ROI and kind of your return on investment with cards. It's so important in cards because, well, actually, let me go all the way back. And so what is gross and net yield? So your yield is how much money you make. Or so, say I purchased this for 50, jeez. Oh boy, jeez. That reflection. Man, golly, yikes. So, with this reflection, sorry about that, guys. So say I buy this card for $50 and sell it for $100, right? So my ROI would be, my net yield would be $50, right? You can do that as a percent, say 100%. My gross yield is $50 for all intensive purposes, because roughly, after subtracting the costs, I made $50 in profit, right? And there's a little bit of issues we have there, right? Because when I buy this for 50 and sell it for 100, we're not factoring in some things. We're not factoring in eBay costs, the costs of grading, the costs of shipping and handling, and there are all these fees that are included, right? eBay takes 15% and all of these things. So I purchased this card for $50 with $5 shipping. Okay, now we're up to $55. When I sold it, eBay took $10. Okay, now we're at, what, $65, $70. We're going to say 70. And then shipping and handling, when I sold it, was $3 or whatever. So roughly $75. Now my ROI, my net yield, my net ROI, is going to be $25. So you really have to factor that in because there's so many hidden costs. Everything from actually grading the cards to shipping, because typically you're going to be shipping on both ends. And so you really just have to calculate those fees in when you are shipping. And for bigger cards like Gold Star Rayquazas and Charizards and kind of the first edition base set WotC, you're also going to have to pay for insurance. And so you really have to factor in those costs when you are looking at, when you're analyzing the costs, the risks, and the potential benefit. And so those are kind of, that's the difference between gross, you're just factoring in the expense of the card itself, net, you're factoring in all of the things that go into it, and subtracting that from the card's value at that time or what you sold it for. And then going back to the very first concept we spoke about, or I discussed in this video, the opportunity cost, cost of capital, cost of money, is basically evaluating the potential reward of some of these cards, 10, 20, 30% a year, to other investments that have that same amount of risk, which would be like C+ bonds, probably not even double B+ bonds. You're getting into junk bonds when you go. And for equity, they have, the whole beta stuff. If you'd like to kind of look into that more, I'd recommend looking into, for equity, which is stocks, looking into betas, and for bonds, I'd look into the kind of rating system, AAA, AA, single A. I believe BB+ and above is investment grade, and everything below is junk bonds. And it just has to do with the amount of risk associated with that bond and how likely it is that that institute or company is going to go bankrupt, because then you don't get your money back. But that's not what this video is about. It's about Pokemon cards and finance. So if you guys have any questions, feel free to leave a comment down below. And just one last thing is, if you stayed around to this point in the video after everything, please comment down below just the letter E. That way I can see who actually stayed around for the final parts of the video. Thank you guys so much for watching. Hope you guys have a great day, and I should upload hopefully maybe next week, probably next Friday. Thank you guys, and have a great day.